Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
And now, one of our main stories, China and Russia promising to intensify cooperation in countering the U.S. Russian President Putin is in Beijing for a state visit now. Mr. Putin and Chinese President Xi have warned of growing nuclear tension between their countries and the United States. We spoke earlier with JP Morgan Chase CEO Jamie Dimon. He says despite geopolitical tensions, the U.S. needs to engage fully and deeply with China.
China is not a natural enemy of the United States. They have a lot of their own problems. So, to me, we could work together as best we can. And then we have common interests, climate, anti-nuclear proliferation.
JP Morgan Chase CEO Jamie Dimon. Now, despite these heightened tensions, he is moving with caution in China. By the way, he was speaking earlier with Bloomberg's Francine Lacroix at JP Morgan Chase's Global Markets Conference in Paris. Brian.
Let's bring in John Liu, Bloomberg Executive Editor in Beijing, for a discussion about this. So, John, I'm curious whether or not, we see the relationship between Russia and China as transactional in nature. That's what many analysts say, or one of shared values and warm bonds.
I think there's a little bit of both. I think there's no denying that the relationship serves both China and Russia well at this point in time. There is a long history between these two countries. Part of that history was quite tense. There was a conflict back in the 60s and 70s between China and Russia. There's a long border that the two countries share. More recently, I think the fact that both of them have major differences with the United States and with the West in general, that has pushed the two together and has been a big reason why the relationship has strengthened in the recent past.
Is the dependency on one another pretty much balanced, or does someone have the upper hand? Let's say, does China essentially have the upper hand in this relationship with Russia?
Economically, China is the much bigger player on the global stage. It is technologically, when it comes to electric cars, when it comes to batteries, all sorts of these things, China is more advanced when it comes to technology and know-how. And so in this relationship, especially given the fact that Russia is essentially cut off from the global economy in many ways because of the war in Ukraine, it has to depend on China. It doesn't really have another choice. And so if you look at it from that perspective, China has advantages in that relationship.
Vladimir Putin described the relationship as one of the main stabilizing forces in the international arena. Many in the West would probably scoff at that a little bit. But what about Global South?
I think the Global South is, I would call it, sitting on the fence at this moment. Obviously, from Mr. Putin's perspective, the war he's prosecuting in Ukraine, he would argue is legitimate, protecting Russian rights. Obviously, there are many, the United States, the West at large, who would object to that, who would say, no, it is he who is the aggressor. I think for the Global South, they are more interested in economic development, how to improve the living standards of their populations. And this war, I think, is having some real down side effects that are not good for that effort. And so there is a real interest in seeing some way to put it into the conflict.
So if the Global South is sitting on the sidelines, and then I think it's basically the European Union and the U.S. against China and Russia. I mean, am I right in that? And what is the level of tension that exists? Are we stalemated here, or is something going to give in one way or the other?
I think the way that I have heard the Chinese position on Ukraine described is sitting on the fence, but leaning very significantly pro-Russia. And so what you have seen is China providing rhetorical support, China providing things that are dual-use technologies, so things that have a civilian but also potentially a military use. What we have not seen is China is not like North Korea or Iran providing weapons for the Russian war effort. And so it is. I think certainly Putin and Xi have a very strong relationship, and Beijing is trying to support Russia. It does not want to see Russia fall apart. Is it explicitly U.S. West versus Russia and China? I think that's a little bit hard to say at the moment.
So we know that there's a lot of symbolism at play here, and we've talked a little bit about that. Also, some practical considerations, some contracts signed, some agreements made. I don't want to put you on the spot and go into a lot of detail on this, but if you could just, in broad strokes, talk a little bit about what they achieved in that area.
So the two economies are becoming ever more integrated, and that is partly because they fit, because Russia produces a lot of energy commodities that China needs, and China has a lot of consumer manufactured goods that Russia now needs to import because it cannot from anywhere else. And so they fit economically, but also because of the war, because Russia is dependent more on China economically than ever before. The two countries have become much more integrated. So we've seen agreements when it comes to agricultural products, to AI, to all sorts of industries. And I think that will continue. And you actually heard Mr. Putin talking about how 90% of trade between the two countries now is being done in ruble and yuan, and emphasizing that now protects them against a third country, the United States.
When it comes to oil, we know that a fair amount of oil from Russia is going to China, but I don't think we can ignore the fact that a lot of Iranian crude has made its way to China for refining, and this has been a real sore spot for the Treasury Department, with the possibility of sanctions being imposed on Chinese financial institutions. Can you imagine a world, John, where something like that would unfold?
I think the Chinese financial institutions, especially the big global players, have been extremely cautious about how they deal with Russian interests, Russian companies, Iranian companies, any entity that is sanctioned, because the last thing they want to be is cut off from the U.S. dollar markets around the world, and that would be extremely harmful to their well-being. And so they are being very careful. That does not rule out that there are some companies in China who are less integrated with the global economy and global markets who would take that risk. I think this is an ongoing issue and will continue to be as long as the United States and China cannot agree on what is the best way forward for the world at large.
John, I wanted to just spend a minute talking about the IMF and its criticism of the United States, really on a number of levels, surging debt, trade restrictions, and some of these policies that are aimed at China, and even the Fed. So I'm curious, the IMF is basically saying, why can't we all get along? Is the IMF mostly in blame with the U.S., or does it share some of that blame for China?
I think over the last 30 years, in the more recent past, we lived through a period of global economic integration, of free trade, where goods, capital, and talent, people, for the most part, were able to move very freely around the world. That is coming to an end, and I think that is becoming more obvious by the day. And you heard we interviewed Emmanuel Macron, the president of France, and he talked about how now the U.S. is anti-World Trade Organization, China's anti-World Trade Organization. It's only Europe that's still supporting the WTO. So I think a lot of people are feeling that way, that what used to be the world order, the way the global economy worked, is now changing. And I think the IMF's complaint about U.S. policy reflects that.
We have the new president of Taiwan that will be inaugurated next week. And we know, as you said to us the last time we had a chance to visit, John, that this is obviously the hot spot when you look at U.S.-China. Is there something that Russia, Ukraine has taught China about how to approach a situation like Taiwan? Very quickly.
I think the Ukraine situation probably is going to make Beijing more cautious about any considerations about military options, because that has not worked out the way that the Russians envisioned, that Vladimir Putin envisioned. It has not been a quick war executed swiftly. And Taiwan, unlike Ukraine, is an island. It is protected by the United States. It would be a much more challenging proposition than I think Ukraine has been.
John, thanks so much for taking out the time to be with us. John Liu, Bloomberg Executive Editor in Beijing. Let's get to our guest, Anitza Nip, Head of Fixed Income Research for Asia at UBP. Anitza, we had some Fed speak today, and they hit some familiar notes there with higher for longer on rates. The Fed may be in a little bit of a tricky position here. I want to get your views on this because they didn't want to overreact after about 3 months of hotter inflation readings. Now we just got a little softer inflation reading, and they probably will feel some pressure not to overreact to this either. So they'll have to kind of maintain this positioning of higher for longer for at least a time. How does that affect your approach to fixed income?
Basically, we reckon that the inflation is, going to be sticky going forward. Even though we see one figure on the core CPI, which seems to be lower, but I think for Fed themselves, one figure may not be good enough really to determine the trend. They need to monitor more. The labor market seems showing some sort of weakness from the non-farm payroll number last time. But then again, one figure doesn't mean anything. So I think Fed would be patient, and at the same time, they will monitor the data. What we feel would be cut could happen in December this year rather than, like the market sort of consensus of saying July. We reckon that, Fed would need more time to look at that. So most likely there will only be one cut, December 2024.
Can we talk about China now? There is so much going on there, especially where the property market is concerned. One of our Bloomberg reporters pushed out a story talking about the government in Beijing planning to hold a meeting today with key officials to discuss remedies. And today, from what I understand, is the day that we're going to have the ultra-long bonds sold into the market. I think it's about $138 billion. How do you expect this sale to go?
Well, basically the long bond sale, it's more targeting for the infrastructure projects from what we reckon. We reckon it could receive, pretty good response. The main reason would be there has been sort of like limited supply on the long end for a while. So anything that put out at the moment would definitely help to set the benchmark curve, and at the same time, for people to be able to invest longer. Talking about the property market, the measures that they, trying to put up, it's basically trying to clear a few things. First would be to look at the inventory level, because I think that's the top focus that they have, will be sort of lower the inventory level that at the moment. The other would be trying to restore the confidence of the buyer, and also to stabilize the price of the property. So I think they need to target it, in different ways in order to stabilize the market. But at this point, we reckon, we still would look at what's going on and what's the policy they're going to come up. We still reckon that those defaulted property developer would still continue with the restructuring because the liquidity pretty tight. Yeah.
So on the story that we moved about officials meeting with various sectors of the market, trying to push local governments to buy up some of these unsold homes, obviously the developers were a beneficiary and their stocks jumped. What do you think about their credit? I mean, is there sort of a sneaky time to make some money there?
In a way, I think, their target is basically to clear inventory. At the moment, we still need to see what the plans look like. In particular, they are saying that they are going to buy from a property developer at discounted prices. And what sort of discounted prices? Would that have a spillover impact to the secondary market as well on other properties? So we don't know yet. So we need to look at the plan and how's going to fund it through SOE, through LGFV. So I think there's a lot of questions still on what sort of plan they're going to come up. Equities and bonds, I'll look at it in a different way because for developers who are unable to make payments, those defaulted, I think they would still continue with the restructuring. But those that have been surviving, I think definitely would be a good move for them to improve their liquidity.
So we get the data at the top of the hour, the monthly activity data for April. I'm wondering if there's a house view from UBP on what we're likely to see, especially where the consumer is concerned.
We reckon that it could, sort of like stabilize a little bit, in particular on the consumption side. But we not particularly, like looking at a significant jump in terms of the consumption. But we think that it's going to be sort of like, neutral going forward. Yeah.
So we've talked quite a lot about China today. Where else in Asia would you see value in credit or indeed in sovereigns?
Well, we have to look at, where the Fed would go, right? At the moment, we reckon like December will be the time that it's going to get rate cut. So fixed income, we look at it, would be more for carry rather than for capital gain. For Asia, we like some of the short data Hong Kong corporates, some of the local banks here, in which they're giving you around like 6% yield, which is not too bad. And we also like some of the Korean corporates and also banks, but they are just around like 5.3, 5.5%, which is not too exciting, but good for carry. We also like some of the Japanese insurance company, but they are a little bit longer in duration. We still prefer IG, 3 to 5 years. But then one thing that we recently increased exposure with short data high yield because we reckon that credit spread would be resilient. So it's, would be good to look at some of the Indian high yield at this stage.
Okay. Wow. Anitza, thanks very much. Not only for the discussion, but for coming into our studios here. We appreciate it. Anitza Nip, Head of Fixed Income Research for Asia at UBP.
Our guest is Audrey Goh, Head of Asset Allocation for Standard Chartered Wealth Management Group. Audrey joins us from the Lion City of Singapore. Good of you to stop by. Final trading day of the week. A couple of things seem to be positive for risk assets right now. In the States, I think the market is kind of increasingly confident in this idea of a genuine soft landing. And from the China side, we're getting indications that officials are really kind of trying to address the property problem, and maybe the economy will feel some sense of fortification. Are you apt to be long risk assets right now?
Yes, we are. We are quite constructive in terms of overweight to our equity markets relative to bonds. We continue to believe that the soft landing narrative is actually very much in play, given that, even from the US, while data point has been disappointing in recent months, for example, they are still reasonably supportive of a not too hot, not too cold economy that should not trigger any additional rate hikes by the Fed for that matter. So if you look at the latest industrial production or even sales growth for that matter, it stalled somewhat in April. But having said that, labor markets still continue to be chugging along quite nicely. So that really feeds into the narrative of a soft landing, which should then support risk assets in our view. And then on China itself, and the good thing about China is data point is actually starting to improve, and we are seeing economic surprises actually holding up better relative to the US, which is why that in the short term, some funds flow are rotating out from the US into China as well.
I will push back a little, not a personal view, but just an observation that revenue for some of these big companies like Alibaba, Tencent, and JD.com are only up around 6 to 7%. That's a far cry from what those companies used to be doing. And in terms of equities in the U.S., we're sort of back to what we thought we had before, which is disinflation. We had the spook in the first 3 months, and now we're back to something that was already factored into markets. The market's already gained a lot. So, there's probably not a big catalyst from disinflation because we knew it. We planned on it. We expected it. And in terms of growth looks like it's going to stumble a little bit here in the short term. So are you concerned at all that, we might actually have a little bit of trouble gaining in equities even while the environment seems okay?
Well, I think there's room for other parts of the equity market to catch up, whether is it, from the US tech broadening out into other parts of other sectors in the US, and whether is it from the US into other parts of the markets, for example, in China, in Asia. So we do see room for that to happen. If you think about it, I think the fundamental construct behind US equities is really solid, where we've just been through the first Q earnings season, and more than 2/3 of the companies have outperformed their estimates. And more importantly, we have also seen analysts revising up their earnings estimates for this year and into next year as well. So that's quite a strong fundamental backdrop supporting US equities. Yes, you're right. They could take a breather in the short term because they have done pretty well in year to date so far, which is why in the near term, we do see some signs of funds actually rotating out of US, which has performed well, into some of the laggards. And here we talk about China as well as Asia, where data points are maybe not as disappointing as before, but starting to stabilize. But above all, positioning is light, and they are also quite cheap from a valuation perspective.
Audrey, where are you guiding clients right now? Into what markets?
So we are still overweight in terms of the US market. So that's our largest overweight that we have. In addition to that as well, we are also constructive on Japanese equities. And we see the recent consolidation in Japanese equities because of a stronger yen as a good buying opportunity for investors to consider buying on dips. So those are the two key markets that we like. But above all, we are constructive on global equities as a whole because we do see the business cycle continuing and extending, given that monetary policy is probably set to turn easier over the latter half of this year compared to, say, a year and a half ago where it was all about rate hikes.
Yeah, the one good thing with disinflation might be a lower dollar. I know there's so many inputs into currencies, it's kind of hard to figure these things. But if the dollar does weaken, is that particularly good for Asia and even more so for Southeast Asia?
Yeah, certainly. That would be one additional catalyst for Asian markets, China markets to perform is via lower US dollar as well as lower US bond yields as well. So that normally has a positive effect in terms of fund flows into this part of the world. In terms of the dollar, this year we have more of a range-bound view because it is an election year, and depending on the policy to be enacted by the incoming new president, the dollar may react quite differently, which is why for this year we largely expect the dollar to probably trade in a range until we get more clarity in terms of what the new policies might be from the next president.
We've been talking a lot on this show about artificial intelligence today. How are you feeling about the AI trade these days? Is it pretty much stretched so finely that there may be limited upside from here?
No, we still like the AI trade. We do think that there's still room for it to continue. In fact, one of the key drivers for AI is to really enhance productivity for some of the middle-range, middle worker, for example, mid-market worker, for example, which is an area which I think is underappreciated by the market. Because if you think about it, instead of 30 minutes to write a report, we can spend now 10 minutes. So it's a great productivity booster.
Okay, a big booster. We'll leave it there. A great weekend to you, Audrey. Audrey Goh, head of asset allocation at Standard Chartered Wealth Management, joining us from Singapore.
This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.